Welcome back to the channel. If you copy trading, you're an absolute moron and you decide to lose all your money. And with that out of the way, we're going to look today at a stock called Herbalife, ticker HLF. A pretty popular company if you haven't heard about them. They have this energy and health nutrition products that they sell through multi-level marketing, being quite popular over the news in the last few years due to the beef between Bill Ackman, which was betting against the company, and Carl Icahn, which bought the company. And as you can see, here we go back in time, the company is in an absolute downward trajectory and it has experienced a bit of a pullback in recent months following this gap here. So we're sticking currently around a level that the company has not been sitting since 2008. So you could see how this is a pretty key level that we're currently sitting at following this massive drawdown here. And I had a look at the cycle where the company is at the moment and what's been happening with it. And I think that there's further room for downside. I'll explain why. First of all, let's look at the valuation. As you can see, there's been a bit of a spike here with the valuation, and the reason for that is because they downgraded the earnings for the next 12 months, hence why the valuation has gone up without the stock price necessarily moving too much. So if we compare that where we are compared to where the company has been, you see pretty quickly that the company is above where it has been over the last few years since the pandemic. So the quants, when you look at the company, signal to me a short. Let's have a look at what the expectations are. So you can see here that the sales are expected to remain kind of flattish. The expectations are as well that gross profit is going to increase just a little bit, and EBITDA is also decreasing. EBIT decreasing as well. Net income down. EPS down. EPS on a GAAP basis also down. So definitely this year is not great for the company. Now, something to bear in mind, if we look at where we are versus the start of the year, the company started around 15 and is currently at $10.27. So that's about 35% decrease year to date, which you could argue it's been quite a big move already, and therefore we have to ask ourselves if there is going to be further juice to find here in this trade. But at the same time, let's not forget that when they reported earnings in February this year, the stock went as low as the high $6, right? So arguably, it has also gone up quite a bit since then, and therefore you could say that all things being equal, or if these trends that are impacting the company are going to stick around, we could be revisiting those levels. So the PE at the moment is not very high. We have to ask ourselves, well, how much lower can it get? Can it revisit the 3 times, 4 times multiple that we saw earlier this year? That's pretty much where it has been sitting, arguably since December 2022, with as high as 9, which I can't see a reason why it could be revisiting those levels, but we shouldn't discard it. Likely we're going to be sitting between the current range that we are, just under 7, all the way down to 4. So actually that gives us quite a bit of range, and with this price, quite a bit of volatility. Now, the options for this stock are around 60% on implied volatilities. The market is expecting a big move with this company. Let's look at the last earnings report. And I think that the reason why we see again this bit of a rise, and also after earnings here, this is the earnings report that we're looking at here. You see this rise. I think that's because they raised the EBITDA guidance for the year. But to me, when you look at this earnings report, May 1st, and you dig a little bit deeper beyond the headline number, I don't see quality growth in the management commentary. So even though EBITDA guidance was raised, then you see that the way in which this has been achieved is primarily through cost savings, right? So management mentioned that they have uh, stayed laser focused on cost reductions, driving that EBITDA outperformance. What I didn't mention is that there's been a lot of cut on capex, and also if we look at some of the interesting metrics that they give us here, you see a decline in their largest market, which is North America, in terms of net sales. And more importantly, you see regional volume as well, decreasing across most fronts except for APAC and China, with an aggregate negative of 3.6%. So you have this company, it's something that we've seen quite a bit over the last few years with rising inflation, is basically raising prices to offset the shrinking volume sales. That to me is not sustainable nor quality growth. And therefore, I don't think that this rise in valuation that we see here since the release of the earnings report, going from 4.3 to 7.2, now back to 6.6, is justified. Now, the other thing as well is that the price seems close enough to the analyst average price target. But as we continue to see these trends that we see outlined in this report, with sales, for example, uh, the guidance is flat to 3% year on year. And you have to remember that this is not adjusted for inflation. The adjusted EBITDA is actually down compared to, this is the guidance for the next quarter, by the way, is down versus its previous year. And again, same thing goes for capex, where it's pretty wide range, but could be the probability that it's going to be below results for next year. So in terms of the full year guidance, they reaffirm net sales, but again, we have seen already how they are achieving this. In reality, the volumes are down, they're just raising the price, and you have to question whether that is gonna work long term for them. They also raise the EBITDA, but they're also doing this by reducing capex. So overall, that seems to me as a bit tight way for them to achieve their expectations. So in essence, sales estimates are up, but EPS estimates are down. So the problem is bottom line. What is causing this, right? So when you look at the last quarter, it was okay on most fronts, except for GAAP, EPS, and sales. And when you look at the numbers, so let's look at quarterly figures. you can see how sales growing, but a very uh, small pace year on year. Negative expected for this year quarter on quarter. The gross profit, again, we have some negative quarters ahead. And you can see the same as well with EBITDA growth, EBIT growth, net income down as well. If we look at a little bit farther, uh, we see that as well, right? With the EBITDA, shrinking EBIT. So all these things, to me, means that the company is becoming less and less efficient in terms of returning a dollar per dollar invested. And maybe that's the reason why management is becoming more and more cautious about capex because they know that they're not going to get that return out of the money that they put to work. Um, Now, I alluded to already the geographical composition for the cells, but something that we haven't touched on is that the FX mix also has an interesting component. Now, the dollar has been performing quite strongly uh, for most of the year, but if we enter into a uh, period where we stay for high for longer, this could be exacerbated, and you see how that factor has turned a 2.4% into 1.0% growth in terms of net sales on that quarter alone. So if we stick into this regime, so to speak, I think it could be a negative for the stock, and I think that will likely be the case, that we remain in a higher for longer environment. So that's one more thing to take into consideration. Now, China, as we see in these figures here, is an important factor for this company. We see that at the moment is, even though not the greatest market for them, is the only one that is growing at a decent pace. But something that caught my eye is that these guys have to pay $123 million to settle bribery charges in this country. And so something that I think could be a possibility down the line is that they, one, try to maintain good appearance that they're behaving, or two, that further scandals or further issues going on in China are revealed to the public in any way. I think that is a downside risk for the stock. Now, at present, the earnings yield is quite compelling for the company. And that I think is a risk to my thesis. So if you take the EPS from the company, right, 1.76, and divide that by the current price times 31. So that's an earnings yield of 17%, which is actually not bad. Not bad. It is certainly competitive versus treasuries at the moment. And I think this company pays no dividend, so 70% still is quite compelling to consider. I think at the same time, that's what creates volatility in this situation because we could see these issues persisting at the company, leading them to drop the guidance or missing the EPS number that they're expecting. And one of the reasons why that could happen is because of the debt. So the debt at the moment is 2.6 billion versus a market cap of 1. Well, just above 1 billion. So you can see how that debt is quite significant. And again, if we remain in this higher for longer period, um, the probabilities of that happening will be higher. At present, when you see a stock like this that has been for all these years with all the highs and lows and arguably at a current valuation of with yeah 6.6%, it looks to me like a value trap. And the market, I believe, recognizes that too because short interest has increased recently from 12 to 15%. So we have to ask ourselves, is this a stock that many investors out there would pursue to hold for a long term and uh, try to hold it as an investment? I think many of them will, but we have to ask ourselves, is their model outdated? Is this multi-level marketing approach still viable? Because let's not forget that when these guys started, this is all pre um, online purchasing world that we live in today, pre Amazon and all that stuff. It's the world has changed completely, and you have to think about the competitors that these guys have. So to me, I don't think that they are making changes on that front. I think that is not such a compelling way for them to sell anymore. And I think unless they take drastic actions as to how they want to change their business model, it's likely going to stay as is. So, in terms of how to play this, there's um, there's different options available to us. Me personally, I'm going to keep this on my watch list because seeing this gap here and seeing how the stock has rallied a little bit, I think there might be room for the price action to retest this 250 SMA. We have seen how it has done this in August last year, then December last year, and we're kind of halfway through all of this. So I think that could happen over the summer. That is also the 1250 mark, one of the key levels that you see in the options chain. And that would be my preference simply because with this price action, I think it could wait for the retest to see another move down. But also the valuation at the moment is rather low. I mean, how much lower can it go? So I think I'm giving myself a bit more margin to get the odds in my favor at that level. If on the other side, maybe the new information comes to the market, change my mind and I want to enter now, I could play a calendar spread by buying the August and sell the July calendars on a ratio. That is also an option. Hope you enjoyed the video and see you soon.